Hello, good morning. أسعد الله صباحكم بكل خير. السلام عليكم. أسعد الله صباحكم بكل خير. جلستنا اليوم ستعطينا هدف أساسي، وهو أن نبني رؤية كيف أن الصندوق الصناعي يعمل على إدارة التمويل، كيف يحافظ على السيولة النقدية والأصول والخطوات الأساسية للمضي قدما في نفس المسار لكل الفرق. وهذا الأمر يساعدنا أن نتحدث بنفس اللغة ونفس المصطلحات ونفس التعابير في كل المعاملات والإدارات. المشروع لا يتحقق ولا ينجح بالصدفة. ينجح المشروع من خلال فريق ناجح وخطة التدريس ورؤية واضحة للمشروع. إضافة إلى ذلك، عندما يكون لدينا أفراد يتمتعون بمهارات عالية، ويشرفنا اليوم أن يكون لدينا من أهم الخبراء في مجال القانوني في مشاريع عملاقة ضخمة في هذا المجال. لا يبني فقط المشاريع العملاقة، بل أيضا يقدم الدعم في عملية البناء. رحبوا معنا لو تكرمتم بالسيد حسني الموصلي. يتفضل مشكورا، شريك في شركة كيرلاند وأليس للمحاماة. تفضل. أسعد الله صباحكم بكل خير. اسمي حسني الموصلي، محامي شريك في كيرلاند أند أليس. I have solutions about big mega projects and Vita project. I'll be speaking about today about how to make the capitals and how is it possible for us to go. I mean, the project to go through different stages. And also, I'll be speaking about contract documents relating to this kind of thing. Of course, bigger projects are based on a basis on complex contracts and diverse contracts, such as operation contracts, financing contracts, insurance contracts, and so on. We'll be focusing on the financing contracts, but we'll first go through the other offtake and concession agreement. Of course, this kind of project has high risk, and risk can be different based on the type of project. So risks relating to the road projects, for example, are different, totally different from the project relating to, say, for example, renewable energy or alternative energy projects or wind projects. This can cause like different gaps in the project that should be taken into consideration in the contracts. If not, then there will be like gaps in financing, which lead up to documents or securities that will be problematic. So financing structures different given the different types of projects. But again, they have like certain characteristics. The most important of which are is that the cash flow into the project should be expected and should be anticipated, so that we can say the financial structure for a mega project is highly efficient. It should be highly expected in terms of the cash flow for the other projects relating to or the under construction. Also, the capital cost should be efficient enough in balance with uh, the capital cost as well in the market. Financing products are generally highly economic if we compare them with the corporate finance and project finance. Some research studies say that the efficiency are higher in mega projects, particularly financing projects require financing advisors, more advisors, more insurance contracts, which enhances, of course, the cost of such kind of projects. There is one more important thing, is that the parties of the project, given their different nature, different assets being built or being operated, the parties are similar in the mega projects. So we start from the investor, equity sponsor. The equity sponsor has a role, I mean a leading role, that generates the idea of the project, has the professional connections, networking, and the market relationship, and the connecting will bring the licenses and will establish the project company. The project company, a special purpose vehicle, which is a company to build the project based on the contracts, executive contracts that has been agreed on with the parties, implementation parties also submitting the financing, and also the debt service, and also the paying the principal when they are due, I mean when are they mature. As for the other parties, we also have like the procurer or the purchaser by different offtake agreements, procurement, that will provide the raw materials by the contractors. This is a very important. Another one is the lenders. Lenders play such a vital role because research studies uh, conducted by lenders, of course, show us the type and the nature of risk, and also motivate the parties, the owners, to manage their risk in a more appropriate way. Risk management is so big, but we can talk about the types of risk management through contracts or through third parties that can manage these kind of risk if they have like high concern or fear, or they can also be insurance contracts. For each transaction has special documents, but generally the transactions of mega projects should have three types of contracts. First, the concession contracts, and if we go back to the one before, we see these contracts at the higher level and the right level as well of the slide. There are the contracts that ensure cash flow into the project, and we also have the construction contracts, which establish the core of the project and the assets that will generate the cash flow, and we also have the financing contracts with the lenders from this side. The main thing in the contracts, we need to focus on the technical contracts. These contracts talk about building, construction, and operation or commission. The main purpose is to find the assets and the facilities to be delivered to the operator. The term used to describe this kind of contract is that just like the operator should only put the key into the project and start working. Operational contracts are generally linked to the equity sponsors, or a company linked to equity sponsors. We also have like procurement agreements, which are linked directly with the performance of the contractors or the subcontractors or subsources that implement the projects or assets. It is very important to have a kind of alignment and consistency, harmony between the different contracts. We don't need any kind of gaps. If these gaps exist, it means that we will have like more risk and will lead up to the different costing and the pricing where lenders can impose and put. So what I'm trying to say is that any gap or gaps in the network of contracts may lead to gaps or delay the closing contracts, the financial contracts or transactions. This will increase the cost, such as advisors or consultants with the time. and will increase also the documents. The final types of contracts is the financial contracts. Financial contracts, the key focus is to provide financing and the cash flow into the project outside the investment provided by the equity sponsor. The financial agreements, most notably, let me just focus on three ones. First, the common principle agreement. It's a central agreement or contract that outlines the main pillars, which means that a bank and the project management are not necessarily or must not necessarily review like 600 pages every time the company gets into a financing relationship with the bank. So it means that there may be one agreement including all the decisions or the rules or the regulations. So this kind of agreement facilitates negotiation for any other financing or facilities. Another important one is the relationship between the lenders and protects the hierarchy and the structure of their relationship. Also, debts and lending priorities is very important because they are directly linked to legal priorities. Inter-creditor is a kind of contractual relationship between lenders that govern the mechanism of protection of the guarantees and collateral. For example, if today we have like a delay in paying the debts or for any projects may lead to underperforming, uh, like problem issues, may may give the lenders the rights to intervene into the process. So lenders should not behave individually, which may lead like for the value to lose the value, for the project to lose the value. So this agreement governs the frameworks for lenders to take their own actions or procedures, whether forced implementation or giving instructions to the trustees or the agents. Another important thing, which is security document. Security document and provided by the project company and mostly by the equity sponsors or the owner of the project to the bank. This is very important. Another important is the debt service pledge, which is mostly provided by the equity sponsor to provide and ensure or to give assurance to lenders that if, for example, the company is delayed to pay off the debt in certain circumstances, so the equity sponsors will pay off these obligations. Quickly, in terms of the obligations structure, first, some accounts are closed and all these cash flow go into these closed accounts. So when there is a kind of payment by these accounts, it should be like by prioritization or structuring, which of course agreed previously contractually. In brief, the importance, the types of structuring and prioritization of the cash flow outside the accounts, all obligations, I mean operational and foundational obligations, then the debt services and the obligations to lenders and other obligations. Then we have the dividends to the owners. So the last structuring or prioritization is the lenders. Sorry, is the owners or the shareholders. What we see here sometimes hedging accounts to protect their projects from any kind of change in terms of like interest change or interest rate change, or if there is a kind of any exposure to this kind of risk. We talked about the parties concerned and the key documents in these kind of projects. We talked about which is the difference between corporate finance and operate finance. There is one important point. Corporate finance is based on the efficiency and alignment of the company for lenders to provide the financing. Project finance is based on the cash flow of the project company. One more important point is over the course of time in the corporate uh, project finance, there is a change from full dependence on corporate finance, such as like debts or loans by big companies. This kind of financing has changed into project finance, which has been very much common, which goes to special purpose vehicle. This kind of change started back in the 80s in the United States of America and the UK for the big and mega energy projects. It has increased across the world countries over the 20 years with the privatization waves and the increased sector between the private sector and the public sector. This change has come into play because the banks started to provide financing insured by the project assets and the cash flow of the project, and not just like on the efficiency of the company. This kind of change is not from A to B. It is a kind of staged and gradual change. We have different types of financing. Recourse, which means like either limited recourse or non-recourse, or limited recourse, or full recourse, which is the ability for the lender to go back to the investor to request the capital for the project if there is any kind of underperforming. This kind of graduation or cascading, it has benefits, of course, and downside as well. The key benefits is that it increases the ability of the investor to invest in more and more projects and puts more entrepreneurial projects across the market where he or she is. Also, it allows banks that inject more money into the project and can research studies based on the project, and also there will be more and more load on the research study of the project, so competitiveness will be higher across the banks. So banks will be able to give items or costing and pricing for debts more competitively than just like if loans are based on the owner company. The countries that have a new trend, or the markets where they have a new trend, non-recourse or limited recourse, is Brazil, India, and South Africa recently. Speaking of risk coming from this kind of change, the most important is that if this kind of change has come overnight, it may cause the financing rate available for the mega projects. In other words, banks will take time to build their own internal abilities so that they can be able to research and conduct in-depth analysis, because there is a new risk, a new exposure is bigger than like guarantee that can guarantee anything may happen. Of the different key topics, some technologies or emerging technologies, the new technologies that have come into play with not clear returns, it is difficult to depend on non-recourse structures. In this case, of course, there are innovative solutions to reduce the pressure on the sponsors or the owner, so that banks also will have like assurance to finance this project. Another thing that I would like to share some ideas with you is the secondary markets for loans and debts. Over the recent 10 years after the COVID-19 pandemic, it has been very common and more efficient across the global market. Traditionally, the financial packages from mega projects are built on originate and hold, meaning bank will give you money, lend you, and will wait for the repay and will get the money back. This has changed recently, particularly after the global crisis, because more and liquidity in the market, because we have now more investors and their interest rate decreased globally, and also the liquidity available in the market on the market has increased, also looking for new investments. So new funds have come into play, the main purpose of which is to find long-term investments with fixed returns. Mega projects really provide this kind of long-term returns or this kind of strategies. Having debts across the markets is bigger than the contracts or financing project, because it has to do with the legal frameworks that allow for debts to be moved, different natures of debts. Interest for this kind of markets, they are secondary trading first, or debt trading first. It allows lenders to stay focused on certain projects or investments or certain geography or locations. As you know, some lenders maybe for over years may have focused or may focus on certain projects, but now after a certain period of time their own credit policy will change. It can be, for example, by reselling the debt, which means that they will focus less on exposure on certain project and markets. This kind of markets, of course, allows investors to reduce and decrease the balance sheet, a load of in terms of the loans and debts they have taken. So these big loans are linked to guarantees by the investors. At the same time, if the investor and the bank do not know that one day they may come up with this, of course, so the terms and conditions they agreed on will be there or will be limited. But if the two parties understand that this debt may go to a third party, then competitiveness will be higher in the market of financing projects. These are the key points I wanted to share with you in terms of financing mega projects and moving from non-recourse to limited recourse structure. In summary, financing mega project is not financing very much like companies, but it is more complex, that is based on different agreements that should be aligned and consistent to protect risk, manage risk from each and every party to manage this kind of. Thank you so much. Your attention is highly appreciated. Thank you. بسبب الوقت ندعو المهندس أحمد البقعاوي ومحمد العسكر لتكريم المتحدث حسني الموصلي. تفضل مشكورا. شكرا جزيلا، شكرا لكم جميعا. رحبوا معنا بالأستاذ سعود العواد، مستشار أول لنائب الرئيس التنفيذي للقانونية في الصندوق الصناعي. شكرا. السلام عليكم ورحمة الله وبركاته. Thanks for Mr. Husni Musali giving us the general framework, of course. And my presentation will be like practical exercise and a practice for the SIDF over the recent years. Of course, Mr. Husni has given us, and thankfully, the general idea about the legal framework and the legal contract documents, and particularly he focused on the project with high exposure without getting back to the project or the sponsors. Of course, generally they are uh, divided into documents, financial documents and legal documents. And also he talked about quickly this the most important one is the CTA. This agreement and can be the law, the constitution. So the CTA certifies governance, reporting, distribution test, and events of default. It ties, of course, triggers and construction milestones to cash controls levers and points enforcement back to the STID for decision classes. So this will be reflected, of course, legally into this. I mean, the CTA will be reflected and will be guarantee the full harmony and consistency between the lenders and the financiers across different projects of investments. This is from the side of the CTA. We also have the intercreditor agreement, or known as STID. The STID, of course, outlines and defines the unanimous or super majority administrative decisions. Also, it appoints the agents and prescribes intrusion mechanisms and conflict resolution. It also shares enforcement to proceed pari passu and integrates Islamic participants without fragmenting recoveries in terms of the underperforming or payment, and all these. The agreement governs and regulates, of course, these issues. So it guarantees the decision mechanism from lenders to the project. Of course, they should have like or they will face negative obligations, if meaning that lenders cannot have the all rights to make decisions individually. There will be, of course, they will have like assurance to rest assured for lenders, regardless of their own nature, whether owners of the project or the company of the project or other lenders or of taker or other providers. So there should be assurance for them to be like individually without getting back to them. So this agreement ensures this kind of project. The agreement also, the other agreement relating to the accounts agreement and the waterfall. The accounts agreement opens and governs project accounts. It also sets the priority of payments, and also it defines reserves such as DSRA and MMRA, and also it embeds blocking and unblocking notices to move from business as used, as explained by Mr. Husni, and to move from business as usual to enforcement control known. It also know who can issue each notice and what changes the flow of funds. Also, this will be allowed only when dividends or profits to be distributed and shared based on strict controls, when the project will produce more returns and more profits, to ensure and guarantee for the owners of the projects to benefit from the dividends. This is in general relating to the three agreements or the financing agreements. For us, this is relating to the financing agreements. That this is, or these are the three agreements. As for the security package and debt service undertakings, we talked previously about the three agreements, which include guarantees and how they are realized. I mean, the deputies and the signatories are on the agreements, and the agents or security agents. And sometimes it depends on the nature of the project. Sometimes security agent or local security agent or global security agent, and some other roles as to make sure to get back and the legal documentation of these guarantees, diverse guarantees, such as receivable of the projects. These need to be they need to be controlled by the agents, the security agents, and the bank account, and also the lender agent. This, of course, ensures us to strike a balance, a good equation between the different parties, as Mr. Husni explained. Non-recourse and the limited recourse. This is something for something else, which means that if the project sponsor or owners requested financing for a project to have recourse because they have provided guarantees from the partners, so this will ensure to have like high level of control. If they refused, of course, to provide guarantees from the partners and they requested to have like non-recourse, this requires more control from the lenders of the project. So something for something else. In such a way, the higher recourse is not guaranteed by for lenders, then they will have like higher control over the project, and they can intervene, and even they can place their hand on the project or the project company, or even they can move and transfer the project to some other parties, so that they can have safe side for their loans to be repaid. Other issues that are very important, the DSU, which means the debt service undertakings. The debt service undertaking is an on-demand sponsor commitment to fund covered debt service. It also fixes liquidity, not everything. We insist on explicit SIDF coverage, clean demand timelines, and several, not just joint liability. So how these gaps are bridged or closed. So the DSU can help to inject cash flow or money from the partners to close this gap and benefit from their money for some other purposes. And normally, this kind of undertakings are separate. It meaning each partner need to guarantee their own part or their own shares. So they will be individual or separate undertakings. For example, 50% of the project for a partner, or 30% and 40%, and 30% to three partners. So each partner, if a partner has like 40%, he should guarantee 40%. He has nothing to do with the other two partners' shares. of the other important agreements is the direct agreement directly linked with the documents and the finance documents. We have seen these in the guarantee agreements and the debt agreements. This is a kind of direct relationship between the project company and the lenders. We have other issues, EBC, for example, engineering, procurement, and also off-take agreements. They have nothing to do with these kind of agreements between the project and the off-taker, between the project and the construction company, and other agreements. So lenders cannot intervene or interfere into these agreements, and this is like a guarantee by the direct agreements signed by the agent, the lender agent. They send the guarantees with the other parties so that they can create this kind of harmony and alignment between the two parties, or the two parties of the lenders. So they need to strike a balance, and there should be like negative obligations for the sake of the lenders. For example, offtake, if there is a problem in the project, there should be like legal penalties, that no single decision is taken individually on the project company unless otherwise lenders are notified or noticed of this. Then of course they can have like some interventions or negotiations at the end to protect the rights of everyone. And the loans or the rights of lenders can be so big. It can be up to like control the project, manage the projects, or even dismantle the whole project, or even push the project from the project company to another company, in terms of like interventions, the purpose of which is to protect the debts provided by the lenders. All these rights are given in return for the debts not to be recourse. And this is based on deep, and there should be like always, and this is something has been unique for the SIDF, particularly when it comes to the research studies at the SIDF, market studies, for example. This is very important, and this is based on one thing, which is like financing project for the SIDF, because it is always based on growth and development, relating to how SIDF gets into financing these projects. It could be different like cases, different possibilities with the lenders, with the project company. It could be bilateral, the only financer, and there will be like two-way or two-party agreements, which is known as bilateral. And we have a lot of these bilateral agreements. It could be 50 all the way up to 75% of the cost of the project to be financed. So the SIDF can be the only lender to the project. So the structure can be simplified in comparison with other structures. Other structures can be parallel, which means like separate perimeters and securities. SIDF finances its perimeter, while other lenders finance different assets with no shared STID. Also, coordination uses notice undertakings, negative pledges, also carve outs, and calibrated cross defaults. So for example, global banks can invest like one production line or two production lines, and the SIDF may finance one production lines and fixed assets, for example, and the other lines of production can be financed by other pools of banks, for example. So here, financing is conducted by two parties, the SIDF and the other group of banks. Each party has their own securities, nature considerations, but there is like negative undertakings or obligations from each party. There should be a close coordination between the two parties. Even if, for example, the SIDF finances one production line, at the end of the day, the SIDF is part of the whole team, and it cannot implement anything without close coordination with the party. And this is for the interest of the project development and growth, and lenders as well. SIDF may get involved in different things, such as like shared financing with the lenders, even not like directly, but share them or shed them in financing, and also the collateral and known as the guarantee agreement, where of course we connect a Saudi law SIDF loan to a shared English law stack. And of some examples that were shared, NEOM, for example, for green hydrogen, NEOM shows a shared pool where STID coordinate multiple lender groups. SIDF connects through a Saudi law undertaking that recognizes agents and decision classes. The accounts agreements defines reserves and blocking acceptable credit support backstops for the, and also the DSRA and the MMRA type obligations. The result is coherent collective action. So the SIDF did not sign an agreement directly, because these agreements are generally in the market under the English law or subject to English law, and dispute is settled based on the English arbitration. All is in English, and we cannot sign such kind of agreements unless otherwise there's a kind of an exception where, of course, the fund will give the rights in terms of the obligation along with the lenders without signing these agreements directly. This is one of the examples I wanted to share where the SIDF get engaged, a kind of shared. Another one is Amiral Saturn expansion. It was about 41 billion Saudi riyals, where the SIDF was also, it is Aramco Total, and the Export and Import Korean Bank. This structure, Amiral structure, also has a very important point. It is expansion project. The key project is refining, but this is expansion for petrochemicals. Of course, the fund has participated or has co-financed the first part of the project, and also in 2024 also co-financed for the expansion purposes. It was in the NEOM structure to finalize and complete the expansion, and it was like a key action. Based on this, of course, there will be like a kind of integration between the previous project and the new project, meaning that in the construction stage, some lenders are still there for the current project. So the new project or the upcoming project will take their rights, and they don't want to share lenders for expansion. I mean, they don't want to share the returns of the first project in the construction stage. Each project, each cash flow coming from the expansion will be separately considered, and each project has a standalone consideration until the full completion. In this date, of course, the two projects will come as one and will be considered and dealt with as one big project in terms of financing and co-financing. They all will be working as one team with one collateral and one cash flow. This was the practice where the SIDF practices in SATORP. One more project for energy. Owners were Aramco and Aqua Power and another American listed company. This project was in parallel. The SIDF took guarantees in a different way, in a way that is different from the other lenders. These are some examples of previous projects. These are the most important practices, the previous practices for the SIDF, for the financing mega projects. They are all key ideas shedding a fresh light on the legal issues impacting on financing of projects. These issues and the key or the main keys, of course, shed the fresh light on each and every sector, and where knowledge can be expanded, and it is just like to shed the fresh light on key points, and each subject matter expert, of course, can talk about this and can further speak about. If we'd like to speak in the credit, we have the modeling of the financing, modeling for financing of projects. Again, relating to the credit risk, the guarantees provided, the types of guarantees, and how to ensure, and also the market research study and the offtake agreements and the legal consideration. There are different issues that are advanced actually, and we can enhance our professional expertise. Other considerations that are always referred to, the specialized financing. There are different issues to finance projects, but again, for each sector has different issues that is different from other sectors. For example, financing projects for renewable energy or infrastructure or industry or mining. Each sector has its own nature and considerations, details, and certain risk where, of course, they require special care from all considerations, whether legally, financially, administratively, research studies, market research studies, or technical issues, and also the credit side. These are the key points I wanted to share with you. Thank you so much. Thank you. Thank you. Thank you so much. Thank you so much. If you have any questions, you are most welcome. Any questions? Please, if you have any questions, feel free to ask. Thank you so much. Your Excellency kindly requested to honor Mr. Saud Al Awad, for the great presentation and the inspiring ideas. Thank you so much for your engagement as well. Thank you so much. Please. One co host.